Hello and welcome to Money Control. Well, the last few sessions have been quite eventful for the markets. First, a dash to the all-time high, and then a sell-off in mid-caps. How do we go and where do we go from here? To talk about all that, I have with me Prashant Khemka from White Oak. Prashant, thank you so much for taking the time out to talk to us today.
My pleasure, Mahalakshmi. Thanks for having me here on your show.
So, first question, what is your reading of yesterday's sell-off in mid-caps?
Certainly. So I would say, see, small and mid caps over the last 5 months, pretty much from March 28th, so little over 5 months. If you look at the charts, they have gone pretty much unidirectionally upwards. Yeah. Almost ballistic, like the rocket taking the Chandrayaan to the moon. Now, this is, though, the market. You can't keep on going up like this. And I think while there are always going to be fundamental reasons cited for why these various sectors and themes that are particularly riding this boom merit to do so. But I do think there is a strong impact or influence of the fund flows that we've seen in small cap, mid cap segment. The mutual fund flows we are all familiar with. I don't have the numbers at the top of my head, but disproportionately large amount of flows have gone into small and mid caps. Small and mid caps, particularly the small caps, are less liquid segments of the market. It doesn't have the digesting capability to digest such large inflows in such a short period of time. And so certain segments within small and mid cap, which are also simultaneously the favorites of the retail public. So not only the flows coming through mutual funds, but also if you were to add flows into the PMS and AIF segment, and then the inflows from retail public or HNIs investing directly in some of these hottest themes, I think there's just too much money chasing a fairly small, less liquid segment of the market. And that has pushed up the prices over and beyond what fundamentals themselves might merit. Even agreeing, notwithstanding the fact that the fundamentals are, say, let's agree, looking very promising. But the fund flow driven push to the stock prices is, sooner or later will have to be unraveled, as that is not sustainable. And whenever markets go up like this, it's not necessary that one fine day they'll then revert back and come down. But to begin with, it starts with some volatility. And yesterday was the first day after 5 months that saw some volatility. And you can expect more such days in the coming days, in my view.
Yeah, that's precisely my next question. So do you see yesterday as a harbinger of bad times for, small mid caps over the next course of the year?
I think that would be too strong a statement. First of all, I want to clarify, notwithstanding anything I'm saying, we are very bottom-up stock selection-based investors, and we don't have any confidence in our own macro predictions, and certainly no confidence in anybody else's macro predictions or the market predictions. So let me give that important caveat. Having said that, I think what I do feel is that certain pockets of the small cap segment, the deep cyclical, domestic oriented, be it, manufacturing, power sector, defense sector, some combination of these are overstretched. And at some point in future, I don't know whether it's next month, next week, next year, or some point down the line, I believe collectively these segments of the market would be available at lower prices, stock prices, than where they are today. Not necessarily the whole market. Large cap, there is no such frenzy. Large caps are up some mid-single digit, high single digits year to date, which is like earning cost of capital or time value of money. But these particular segments, deep cyclical, leverage, somewhat weaker governance, highly domestically oriented, these segments would be available at lower prices, seems reasonable conclusion in my mind.
So, Prashant, to your mind, how stretched do you think are valuations? If I were to just tilt this question put this question in reverse, how much correction do you think is possible for this lot of stocks to come back to fair value?
I haven't done any calculation as such, but Mahalakshmi, some of these stocks are up 100, 200, 300% in the last 4, 5, 6 months. Yeah, so some of these stocks can come down. So if you're up 100% and you're down 50%, then you're flat.
Right.
Yeah, you're up 300%, then you're down 75%, then you're flat. So some of these stocks can come down in a sustained downturn, 50 to 75%, and go back to where they started or even lower.
Sure.
Again, I'm not saying all these names. There would be certain names which would do very well from these levels as well over time. Yeah, just like the 2006-7 bubble of in real estate and infrastructure. There's very strong fundamental case for real estate and infrastructure at that point in time as well. Like a billion plus Indians, they will billion point five going to billion point five. We'll all need houses. We are all the families are nuclearizing and so on, and we all needed roads and more infrastructure and all these. And actually, infrastructure has continued to play out, and country has seen an upgrade in infrastructure. But the many of the companies from 2006-7 timeframe are no longer around, or at least not in meaningful size. Other companies have done from 2006-7 also. Some of the companies have done very well, but on the whole, the sector, did go through very difficult times because the prices were stretched to extraordinary levels. And similarly, what I'm saying right now is that in some of these segments, some companies would do well over time, but a lot of the companies would be available at far lower prices than where they are today.
Sure. Prashant, at this point, I just want you to elaborate a little bit on your own, sell side discipline. How do you exercise or guard yourself from, sudden crashes? Because this whole idea that the fundamental story continues to be strong, but the valuation story has been hazy, has been playing out for a while. But whether it is institutional investors or retail audience, the tendency and also the rule in investing is let your profits run. So because it's very hard to call that inflection point where things will really turn. So can you take us through some guardrails that you have put in place to ensure that you are probably out before a serious correction? How do you see that for yourself, and what would be your advice also for a retail audience who probably does not have the kind of resources the institutional framework gives us in terms of management interactions or the institutional research support and stuff like that?
Certainly. So Mahalakshmi, we always, as a team, always stay fully invested. We don't take market calls. So that's important for me to highlight. It's not that we are moving in cash or anything. We never do that. We stay fully invested. But what helps us, avoid, you can't completely avoid all the pain. If you are in the market, like they say, if you are swimming, you will get wet. So you will also feel some pain, and nobody can, with any degree of consistency, forecast these turns in the markets. But what helps our team is we remain well balanced and well diversified in the portfolio. So we won't have disproportionately large exposure to a particular segment of the market or to a particular or two or three themes in the market. We would have, as I was saying earlier, large caps haven't necessarily seen kind of flow-driven lift in prices. We do have majority of the portfolio in most strategies still remains in large caps. We do have healthy allocation, much more so than the benchmark in mid and small caps. But this rally or frenzy is not necessarily across small caps or across mid caps. There are segments of mid and small caps that haven't seen anywhere near the frenzy that we are talking about in the more domestic and the deeply cyclical segments of the market. So we in our portfolio do have a good balance across market caps, across sectors, so as to not get caught into one or two themes which where you do very well while those themes are working, but then are left holding the bag when they unravel.
So stock wise, so diversification is definitely one strategy, but stock wise, how do you guard yourself? For example, I see some names like Keynes or a Dixon, which are visibly expensive, at least when you look at, based on a growth versus PE multiple, it would tend to look very expensive. Uh, do you just go with the flow and assume that okay, these companies might see serious correction but they will come back up if you hold for a long term, or is there a way to sort of navigate this without getting hurt too much?
Each case is different, Mahalakshmi, as you would agree. Yeah. So, and without taking any particular name, let's say a particular name, the team has bought at 1% position at a time when they thought the upside is, let's call it 100%. So the team believes there's the stock price, the fair value is twice what it is trading at, and the team buys the stock. If the stock goes up 50%, then two things happen, all else equal. The upside left would be only 33% because 100's gone to 150. So if 200 is your value, the upside left from 150 to 200 is 33%. And secondly, the position size, if the rest of the market is, let's assume for a minute, flat in this simplified example, then the position size has gone from 1% to 1.5%. So instead of starting with a 1% position where you saw 100% upside, you now have a 1.5% position with only 33% upside. So in such situation, the team does take a cut or a trim in the position size so as to more appropriately reflect what is the upside left in the context of the fundamentals. Now, it is a very hypothetical, theoretical example that I've given, but in some form or fashion, this plays out in the portfolio. So position size, continuously the team does evaluate because there are other names that are becoming more attractive from a valuation perspective. And we've never subscribed to buy and hold as a theory just for the sake of buy and hold. When we see opportunities to reallocate our capital into more attractive new opportunities or existing names in the portfolio, we do reallocate capital and trim some of the positions which we believe are running ahead of fundamentals and leaving less upside potential. So we may not completely exit, but at the same time reduce the weight, which itself reduces the risk.
Sure. How do you see the railway pack, Prashant? Because that is one part of infrastructure that some part of, I don't think too much institutional money has come into that space, but a lot of retail investors got onto that bandwagon. So how do you see that pack panning out? Because some of the stocks are, it's a little bit up and down today.
No, certainly one has to be careful. First of all, in railways, there are so many different companies that provide so many different, services or products to railways. Yeah? For some companies, railways may be nearly 100% of the exposure. For other companies, railways may be 50%. Yet other companies, railways may be 10 to 20% of the exposure. We do think railways is a segment where a tremendous amount of capital expenditure is going to take place over the next decade or so. And there are many opportunities, many companies whose businesses would benefit disproportionately from these opportunities. So the team continues to evaluate, and we do have investments in the portfolio which would benefit from some of this increased capital spending in railways. But again, would not make it a blanket statement that you can, ride any train, so as to use the pun, in the market that is, supplying or is in this business. as just because you are in the railways business doesn't mean you can merit any valuation. There are businesses which are very competitive. You may be a large market share at this time in a particular segment, but if indeed the expenditure in that segment goes up fivefold, tenfold over the next few years, that would attract new competition. And what strength you have in the company to withstand such competition is very important to analyze. So based on all these assessment, we do have some exposure to railway sector in companies that we believe still provide room for upside in the context of the prospects.
Sure. One segment of the market, Prashant, that has been kind of buoyant today is pharma. Not that, I mean, even in the past few sessions, it has been quite buoyant. And today we also saw a couple of stocks, Aarti Drugs, for example, JB Chemicals, which you also hold. Some of these stocks also saw a lot of traction. So, one, what is your take on pharma? Is it showing some kind of leadership qualities in the mid-cap space right now? And how do you see the specialty chemical space also pan out? Because that's gone through a lot of torture this year. But there are still, those issues related to inventory and stuff like that, which is yet to probably play out over the next 1 or 2 quarters, which is what I'm picking up from analysts. What's your take on both these pockets?
Certainly, so healthcare pharma, we definitely have a lot of exposure in the portfolio, as we do find a lot of companies attractively valued at this time with fairly strong fundamentals. So it has not been a favorite sector in quite some time for the market. At least post-COVID, there was some euphoria for pharma stocks, as people believed for a while that the consumption of pharmaceuticals is one thing that's going to go up post the pandemic. But for almost 3 years now, pharmaceuticals have struggled on a relative basis, though as a sector, though within that, some stocks have done much better. We do find at this time a lot of good opportunities, not just pharma, but healthcare more generally, which includes, hospitals,
Hospitals, yeah.
the services. So the team does like and own several companies in the broader healthcare space, as we believe fundamentals are relative to other segments of the market and overall relative to the market are still very attractive for quite a few of these opportunities.
Sure. And the specialty chemical space?
Similarly, in specialty chemicals as well, we do, yes, in the near term, this year, there's been some softness in demand globally for agrochemicals, which does spill into the sales momentum for various Indian companies as well. But structurally, these companies, some of them remain, again, it's hard to generalize, just as we were talking about within the domestic cyclicals also, even from these levels, many of the companies would do well, or several of the companies would do well, while overall the sector might not do well. Similarly, in specialty chemicals also, we believe several of the companies still have very long runway of business growth, profitable growth, by virtue of the segments they are in and the markets that they're catering to, and the small near-term demand softness notwithstanding, they remain fantastic opportunities.
Sure.
And we do have good amount of investments in specialty chemical as well.
Sure. And how about the PSU space? Because, the PSU pack again was, one of the casualties yesterday, more than, 4% down again. That's also another pocket that has seen a, one-way up move over the past many months. In fact, post-pandemic itself, it's been a huge run-up for them. How do you see that space? Is the problem of overvaluation, does it hold true for the PSU pack?
So, Mahalakshmi, I've always struggled with the PSUs, I must admit, not just in India, but across the world. As you know, we have an emerging markets fund as well. And in other countries, the weight of PSUs in the market is much higher than in India. In fact, the emerging markets average is 20% compared to 10% in India, because there are several countries where PSUs make up 30-40% also of the index. But we've struggled historically to find attractive investment opportunities amongst PSUs. Valuation does on the surface look compelling. They have these companies anywhere in the world. PSUs would have higher dividend yield and low P multiples and whatnot. But the problem with the PSUs in general, again, not talking in particular about India, but in general, problems about PSUs, alignment of interest is not there with shareholders. The government of the day in different countries may have different objectives that they want to achieve. Some of them in the name of social service or greater social cause, and those aren't necessarily the objectives of investors when investing in equity markets. And hence, from a governance perspective, we've always struggled to get comfortable with PSUs or SOEs, as they're called, around the world. We do own some, not just in India, but across the world also, but they are fairly small portion of the portfolio for us. Some exceptional opportunities where we do own some, and that's also to considerable degree from a risk mitigation perspective. When it is such a large component of the market, you cannot completely avoid them.
Sure. Prashant, we started off this conversation and you said that, one of the reasons for prices going up so steeply in small caps, mid caps is because of the money flows also coming in from retail investors through the mutual fund route. And that seems to be showing no signs of abating. Of course, if this kind of volatility continues and the performance, is hampered over the next month or so, maybe some flows might get disrupted. But as of now, large caps are seeing negative outflows, and mid caps and small caps are seeing money that fund managers probably find it difficult to deploy. How do you see the way the valuations are poised, and the market in a way taking cognizance of the fact that there is some valuation froth that has got formed? A trigger for that was yesterday. Is it a challenge, a genuine challenge for fund managers to now be managing small caps at all, a small cap fund?
So it depends. It may vary from fund manager to fund manager. Our team did defer the launch of small caps. Now that might in hindsight seem like a mistake, because that was a couple of months ago, because our team a couple of months ago felt that the small caps are, the valuations are affected by large fund flows and may not be sustainable. Now, this can go on for some time, but eventually, just flows cannot keep the markets up. Yeah, the flows would decline much after the stock prices have declined. So that perception or belief that many market participants, I find, have, that as long as flows are coming, the markets aren't going to come down, or as long as flows are coming, small caps are not going to come down, because the flows are not going to stop. So what happens is, first the stock prices come down despite the flows continuing. Like you saw, whatever be the pretext.
Right.
Yesterday there were some stories why they came out. Now, yesterday, it isn't that small cap flows stopped yesterday.
Right.
If you see, the fund flows for small caps would have continued yesterday as well. But the small cap index was down 4%. So that is how typically it will happen. Now, it was just down yesterday. Today, it might be up. So initially, there'll be volatility. Now, there would come some point in time when the small caps come down, and then come down again the next day, and then come down again the following day, and then keep coming down for several days with some intermittent maybe upside. And then investors say, well, wait a minute. Now I'm losing quite a bit of money. Maybe it's not a good idea to keep blindly putting in small cap funds. Let me pause. And then the fund inflows would slow down. Fund inflows would slow down much later, much after, typically, typically. Again, every time is different, but typically it might slow down much after a sharp reversal.
Sure. And in terms of alpha opportunities, do you see any opportunities at all in the small cap space the way they're poised right now?
Absolutely. Almost by definition, there are alpha opportunities at all times in large caps, mid caps, and small caps. Because see, the market, if the market is overvalued or undervalued, we don't know and we don't presume to know. We say they're always fairly valued, notwithstanding everything that I've said today. Yeah, we still would not take a call in our portfolios that small caps are overvalued. Let's get out of small caps. Our view is let's out, even if let's hypothetically assume the whole market is overvalued. Yeah, hypothetically, I'm not saying that's what our team believes, but let's hypothetically assume the whole market is overvalued. Within the market, there would be some names that are undervalued and some that are excessively overvalued. So the idea for us is to beat the market at all times. So look for what is relatively undervalued opportunities. And same thing you can extend to small cap space of the market, right? Small cap segment. Even if we were to assume, as I am suggesting, that overall a small cap space may be overvalued, within that overall overvaluation, there would still be names that are substantially undervalued, and there are many names that are substantially overvalued. So if we as a team can do a good job at identifying the undervalued opportunities, then we can generate alpha in an overvalued segment of the market as well.
Sorry. I should correct myself because I didn't ask the right question. It's not what I mean to ask is in terms of absolute returns. Do you see opportunities that can give you absolute returns? Because the very nature of the index is there will be some. It's only an average, so you will have outperformers and underperformers. But in terms of absolute opportunity for returns, do you see there is opportunity? This I'm asking specifically in the context of our retail audience.
No, absolutely. See, again, what is the time horizon is also important. It's impossible to talk about. So in terms of relative performance, I am always very confident in our team's ability to generate relative outperformance. Yeah. Now, absolute return, oftentimes I joke there's no such thing as absolute return in the near term. Or what I mean by that is there's no predictability to absolute return in the near term. In the long term, obviously, if you have an economy that is growing 6% real terms and 10+% in nominal terms, then if you go out 7 years, the nominal GDP has doubled in 7 years. And then in 14 years, it has quadrupled. Yeah, and so on and so forth. If you can keep doubling. So over a long period of time, if you identify good stocks, then they would give you absolute return over long period of time. But yes, in the intermittent time period, the market doesn't go up 10% a year. Though over time it does deliver 10% a year, but not every year like fixed income. In the near term, there could be negative absolute return all the time. I've always said that any investor in the market should be ready for a 20% correction at any point in time. And in every decade, pretty much, or at least I would say every generation would see a 50% correction in the market. Yeah, that's been the historical experience as well. So I'm not saying something new. And we don't know when that next 50% downturn may take place. So that can happen. But yes, over time, if you do the job right, you will get strong absolute return than almost in any other asset class, as well as strong relative return performance if you do it right.
Sure. The one hallmark of this entire market over the last 3 years has been, every 3 or 4 months you have sector rotation happening, which is what, keeps stocks also in check, and that's what has kept the rally also going. Where do you see the momentum moving next?
Again, it is impossible to say, Mahalakshmi. And the way we address this is we don't try to predict where the market is moving, because as I'm saying, it is not very difficult. Sometimes our team members say it is very difficult. I correct that. I'm like, look, something that is very difficult means it can be done. It's just very difficult. Whereas something that is impossible is just impossible to do. Now, yeah, when I say impossible, It's like predicting a coin flip. Predicting a fair coin flip is impossible, but 50% of the time you'll be right, 50% you'll be wrong. So that's what I mean with these sector rotation things as well. Our view is, look, in each sector, if our team can pick the winners long-term winners in each sector, in each market cap segment, yeah, then over time, such a portfolio would handily outperform the market or the benchmark. Yeah. And over time, the market itself is likely to deliver returns in line with the nominal GDP, which is about 10%. That's been the historical experience. Obviously, historically, nominal GDP growth over the last 30, 40 years, if you see, has been stronger because GDP deflator has been higher.
Right.
Uh, so depending on what time frame, since last 30 years has given 12% return, last 15, 20 years would have given 10, 12% return. So depending on nominal GDP, market would deliver, I think base case reasonable expectation is 10% odd return going forward. And if we can identify good, attractive, outperforming opportunities in each sector, then such a portfolio should be able to outperform the market. And that's the approach the team takes at identifying individual businesses in each sector, each market cap segment, which can outperform the sector. So the best financial company, the best IT services companies, the best pharmaceutical companies, the best consumption companies, we don't then have to worry about which sector is going to do better than the other, because that's impossible to say which sector is going to do better than the other.
Fair enough. What's your sense of the fund flow scene, Prashant? Because over the last few sessions, you've seen, net outflows. And of course, on the strength of the retail optimism and sentiment and mutual fund flows, we've been able to march ahead. Do you see that getting dented because our performance from a stock market perspective has been better than most other markets? Is that coming in the way?
So I often say rising markets draw in more funds, more investors always, and vice versa. So globally, if we were to speak about, globally, there is tremendous interest in Indian equities, but that is to be viewed in context of a weak appetite for equities in general and EM in particular. So the stars, the biggest flows you are going to see in the Indian market when all the stars align, like 2003 to 2007, there was strong appetite for equities globally. There was even stronger appetite for emerging markets. Within that, far more appetite for BRICS, because the acronym BRIC was coined around then. And India was the eye of the BRICS, right? So India's had all the stars aligned in terms of foreign fund flows during the 03 to 07 time frame. Today, if you see, global equity appetite is weak. Appetite for EM investing is even weaker within global equities. India is the only star that is aligned, if you will. So relative to other EMs and other places in the world, India is standing out. And you do have a lot of clients who are making first time allocation to India as a separate standalone investment. I think oftentimes Indian retail investors don't recognize that out of the $750 or so of foreign money that is invested in India, 80%, nearly 80% is through multi-regional funds like a global equity fund or emerging market equity fund. So if you see an outflow, like last year, there were outflows from Indian market. That wasn't necessarily an investor hitting a button to get out of India. It may be investors, which was the case last year. Investors were exiting emerging market funds. So when emerging market fund someone sells, the fund manager has to sell across all countries, including in India. Yeah, so that's why I think at this time also, like last year, the India dedicated, which is the 25% of the 750 billion, I think that allocation is increasing, and there are new investors who are allocating in that India dedicated pool. However, the vast majority, which is this multi-regional EM and global equity funds, those are seeing outflows, and as a consequence, we might be offsetting the India dedicated inflows.
Fair enough. And in terms of the way the global macros are poised, also now oil rising, do you see any risks coming from the global setup?
See, what you're effectively asking is, or let me put it this way, anything that so materializes that there is a sharp pullback in global equities. If that is the case, India would feel some of that as well. Though last year, India held up quite well. India was one of the best performing markets, but India didn't do a whole lot. Yeah. So, what pulls down global equities is again impossible to say because every risk factor that we can think of and we can talk about today has already been discussed. And I think global markets are very efficient in incorporating probability of those risk, probability weighted risk of these events into the prices, equity prices. Now, obviously, if something totally unexpected or something that is a low probability event, like a say Russia-Ukraine war taking a dirty turn and some tactical bomb or something, the risk of that is incorporated in the markets, but the event is not incorporated in the market prices today, right? If some such unthinkable event were to actually take place, then there is, yeah, that unexpected downside risk. From a domestic India perspective, I think the single biggest known unknown right now is the central election. The market is assuming a certain outcome, and most likely that is likely to be the outcome. But it is not 100% given. If a very low single digit probability outcome were to come, the market isn't prepared for that. And then market would have to sharply adjust for that. So that's just something, those kind of things that are always out there. I'm not saying that's likely. I'm just saying that today it is a 2% or 1% likelihood event, let's say. And 98, 99% odds that, we'll see an outcome that the market is expecting. And if the outcome is as market is expecting, then that's fine. That's what the market is pricing in anyways. But if a low probability event were to occur, then market would have to adjust. Those are just risks. You have to know that those are risks out there. You can't do anything about them.
Sure. Sorry, one last question on stocks. How to approach this market, of course, you said that there is froth in pockets, but when there is acute volatility, say a stock is down 8%, 10% on a given day, is it a buy on dip kind of market, or this is some pockets are to be completely avoided right now and use, any peaks as an opportunity to just offload? In pockets that we all recognize as somewhat exuberant, what should be the approach?
Yeah, certainly. So again, there's no standard formula that works for all these things. I would say, as we do in our portfolio, have a well-balanced, well-diversified portfolio. I think we as fund managers, good thing that we can't leverage, or at least long-only funds. So we never leverage. We never stay in cash either. I think taking cash calls doesn't work over time. Trying to time the market doesn't work over time. For myself itself, what I've been saying might be right today, but I might have been saying the same things 3 months ago and missed out a lot of the rally, right? So we don't take cash calls, and I would never advise anyone to take such cash calls, nor would I advise anyone to ever have leverage. So one of the things as a retail investor, I would say or request not to have leverage when investing in markets, and also ensure that the portfolio is well diversified. You are not like if someone in 2006-7 timeframe, if they were leveraged and only invested in real estate and infrastructure stocks because they believe that is where the future is, that is where all the growth is going to come, then they would have been wiped out or near about wiped out in the 2008 crash. But if you had a well diversified portfolio and you didn't have leverage, yes, you would have suffered a 40, 50, 60%, 70% hit as well. But down 70% and down 100% is a huge difference.
Right.
Yeah. Because to come back to from down 99% to come from down 99 to down 70, your portfolio would have to go up 30-fold. which can take more than a generation.
Sure. But as an approach, would you say this is a buy on dip sort of a market, or one should utilize like a, sell every peak kind of market?
See, I've never believed in buy on dips or sell on peaks because I think nobody knows where would the dip and where would the peak, how long the peak would last. So my guiding principle for the last how so many years, I would say since 1985, when as a retail investor I stepped in, has been to stay fully invested. I've never gone out of the market. And yes, in my early years as an individual investor, I used to lever up a lot. Those are lessons well learned, and that's why I tell people never to leverage and invest in the market. Stay fully invested and don't try to time the dips or the peaks. Stay well diversified, stay fully invested.
Sure. And any pockets that you can call out, Prashant, where you have the highest conviction today in terms of opportunities that can generate alpha?
Certainly,
of course, you said very stock specific and all of that, but yet, is there anything? Is it
yes.
Midcap IT? Is it Midcap banks? Is it, what is it for you?
Yeah, so I think structurally also it is true, and it is true at this time as well, that our team finds the most attractive investment opportunities in numbers in private sector financials, be it private sector banks or NBFCs or other non-lending institutions, be it insurance companies or capital market intermediaries. So even today, the largest and the most attractive opportunities or the largest number of most attractive opportunities is the right way to put it, we find in private sector financials, followed by, I would say, consumption more broadly, including consumer staples as well as consumer discretionary. And then followed by, I would say, IT services and healthcare, both similar sized. IT services has been a fantastic wealth creating segment of the market. Not every company necessarily, but there have been a lot of very large wealth creators from the IT services market, IT services sector. And we believe going forward also there will be huge wealth creators, and we do have several investments in IT services and healthcare we already talked about. And then amongst industrials also, notwithstanding all that we discussed about domestic cyclicals being a hot theme right now, within that, you can find several names in that segment as well, which we believe would do relatively far better than the overall industrial sector. So I would say almost I have not left any sector other than energy and utilities maybe, but we do find in private sector financials, consumption, healthcare, IT, and industrials.
Sure. Sure. Thank you, Prashant. That was a nice long conversation. Thank you so much for taking the time out to join me today. Thank you.
Always a pleasure, Mahalakshmi. Thank you so much for taking the time to talk with me. Thank you.
Not at all. Thanks.